The indexes continue to slide, with October being one of the worst months on record. Several sectors continue to roll, with each and every one of them now being below the 50 moving average. However, the markets are now at extreme levels, which is where major bottoms are found. What are some of the indicators that we could look at to help us identify these market extremes? How has big tech been holding up throughout earnings season so far? Are they helping or hurting the bullish case? How can we play the inevitable bounce that will come? And what upcoming event has the potential to act as a catalyst that puts the bulls in control? We've seen some significant changes over the last couple of months, specifically the last couple of weeks, and we're going to address all of them today. We will also go over key levels to watch and cover some interesting names on my watch list for this upcoming week. That, if we receive support from the broader market, could see some big moves both to the long and short side. I'll sprinkle those in throughout the video, so let's get right into it. Hey everybody, welcome back. So we're going to first take a look at the indexes here. Let's look at SPY. It's not a pretty chart at all. If you could see, we lost the 200-day moving average. We also have now had a successful retest of the 50 following the breakdown back in September, giving us a confirmed, basically we can now confirm that the 50-day moving average is a firm resistance that we're going to have to overcome later on if we are to resume back to the upside. If you just take a look over here, back at late July, you can see that we lost the 50. However, the bears were unable to really take control and push us lower. The bulls took advantage of that, pushed us higher, but were also unable to confirm the capture of the 50-day moving average. When I say confirm, I simply mean, in this case, bears took that 50 moving average. However, they were unable to bounce off of it and confirm lower, right? Retest it and move lower. And then just the opposite, when the bulls reclaimed it, they were unable to retest it and break higher. So in this case here, we did end up sliding. The bears took control with a very powerful move to the downside. They then retested the 50 and resumed the move to the downside. So the 50 is clearly a very potent resistance now for the S&P 500 that we're going to have to keep our eyes on very closely. It's also declining, which just in its own makes it a little more potent because of that decline. And we're now below the 200-day moving average as well, which is a very important level. Technically, an index once below that 200-day moving average is considered to be in its own bear market. So the S&P 500 as of right now is in a bear market. You guys heard me say it, right? I've been your bull for 8 months now, 9 months. One of the first to be a bull only because of what the charts were telling us. And now it looks like we're slowly rolling back into a bear market. Now we need to retest the 200-day moving average and break lower to confirm the loss of that 200-day moving average, just like we did for the 50 moving average. So there's still a little more for the bulls to do in order to confirm their dominance, the start of a new primary trend to the downside. However, it's not looking very favorable right now for the bulls. But there are a couple things that I would like to share later on in terms of where we're sitting with the market internals. It could make things very interesting in the coming weeks. We'll get to that shortly. So right now, what we're waiting for with the S&P 500, if looking to play some sort of bounce, some tradable bounce, is let's add these short-term moving averages, the 10 and the 20. What we're looking for is the first test of the 10 and 20 moving average. So you can see we're fairly stretched from these moving averages right now, which means that the market is overextended to the downside. So what we're looking for, looking back, let's use an example over here. You can see price got very stretched. What you want is, once you get that first test of that 10 moving average, you want to see price kind of firm up off of the rejection. It's generally going to get rejected, the first test. And then once it firms up, it's the second thrust up that is going to give you a buyable opportunity. In this case, we actually made a new low. So it gave us a double bottom neckline to trade. However, the S&P 500 has been very weak relative to the QQQ. So I wasn't interested in any way, shape, or form of the S&P 500 of playing the bounce back in early October. If you look at the QQQ, you could see that it was a lot more appetizing. You could see we retested, we had that thrust down, we got extended, there was air in between that 10 moving average and price, so there was overextension. We then came up to retest that 20 exponential moving average. And then what we wanted to see after that was price kind of firm up, maintain that previous low, and then give us an explosive move to the upside. And it was at this point in time where I got very aggressive to the long side. The group and I we went long TQQ, we went long Tesla, we went long a bunch of different names that were showing relative strength, because those names that were showing relative strength were likely to outperform the index they are pegged to. But so that's what we're trying to do as well this time around. So right now we have our huge move to the downside. These moving averages are clearly very extended from price right now. So we want to let them catch up, because we don't want to, it's very dangerous to short when the market is as extended to the downside as we are right now. Doesn't mean we can't go lower. However, it just makes the risk reward far less favorable. So because of that, I'm really primarily looking at the long angle as of right now. When we take a look at the market internals, it's going to make even more sense. So in order to play that bounce, though, I'm getting a little sidetracked here. We're letting those moving averages catch up. We're looking for the first test of the 10, preferably 20 moving average. Then we want to see price kind of move sideways like so, and then make a strong move to the upside. So that's what I'm looking for in the coming days. We have the FOMC meeting on Wednesday. All eyes are going to be on that. We're going to be watching it like hawks. We're really priced in already at staying where we're at with regards to interest rates. What's going to be very important to investors is the language, the tone of Powell. He sees what's going on in the markets. He understands what his language could basically act as catalyst for, which can be a continued move to the downside. He doesn't want to see that. Is he going to potentially speak with a little more dovish tone, or is he going to continue to hold that firm hawkish stance that he has maintained throughout the course of the last year? We're going to have to see. But if he does shift to a more dovish tone, we could see the start of a move to the upside. Okay, so by Wednesday, these moving averages will have already caught up to price, and we would have likely already had our first initial test of that moving average. We could then see that being either, if it not Wednesday, be Thursday or Friday, where we have that big move to the upside. So there's two different scenarios. We either consolidate sideways here in the next couple of days and then break lower off of FOMC, or we consolidate the next couple of days and then that acts as a catalyst for a break higher. It's going to be very interesting, but until Wednesday, we got to kind of be careful. We don't want to get too aggressive to either direction, simply because we have such a powerful catalyst. We also have to be mindful of Apple's earnings next week as well, which could definitely more so specifically shake up the tech index, the QQQ, which is what we're looking at right now. So after next week, a lot of the uncertainty will be out of the market. Investors can be a little more at ease. That alone can help alleviate some of the downward pressure. Couple that with a potential positive report out of Apple, a potential dovish Powell come this Wednesday, we could see a strong move to the upside. I'm open to playing either direction. That's how I'm going to play it, right? We're waiting for this to consolidate, break lower, consolidate, break higher. Also, if we were to take away these, re-add the 50 and 200 moving average, we are overextended into a major rising moving average. So it's likely we see a bounce here. I'm just based off of experience, it's generally what you see. It's what's more important than price breaking below a moving average is the slope of the moving average that it's breaking. If a moving average as significant as the 200 is rising and price breaks below it, the likelihood that the previous primary trend regains control is fairly high. That's just statistics. Let's take note though that we now have a falling 50 moving average that could give us a death cross in potentially the next month and a half, which would obviously be very negative for the market. You have golden cross. It's very bullish long-term signal that usually coincides with a powerful primary trend to the upside. You have your death cross that is just the opposite. So we don't want that death cross. We need to see the bulls in the next month really step up and protect this trend. Otherwise, we're not looking too hot. If we take a look at the dollar, you can see that we had a very powerful move. And the reason we're looking at the dollar is because the dollar moves inverse of risk assets, S&P, QQQ, IWM. So if this is showing some sort of topping action, if it were to lose this 105.50 level and the 50-day moving average, it would be very bullish. It would take a lot of pressure off of risk assets. So we want to take, into account where this is currently standing. You could see we finally broke this very powerful initial move up. We're now kind of moving sideways. This is normal behavior for a new bullish trend. So in order for this to become more bearish, it would first begin with a break below the 50-day moving average, this rising 50-day moving average. And if that were the case, we would likely see some sort of retest to the 200-day moving average. So that would at least give us some sort of bounce to play in the indexes. What's more interesting of a chart, and that also moves inverse of the QQQ S&P 500, are the bonds. So if we are to kind of just zoom out here, you could see that we are in a very strong primary uptrend, but one that is at very high risk of failure, likely to become exhausted in the coming months, which is good for risk assets. Generally, stocks do not have more than 3 legs up. This is called counting bases. Whenever a stock or any kind of asset has had more than 1, 2, 3 legs, the likelihood that it then reverses or has a very long period of consolidation is very high. So we've had 1, 2, 3, we're on our 4th leg up. Now, it doesn't mean that this can't base again and have a 5th leg up. In fact, most market-leading stocks in major bull markets are going to have 5 legs up. So it's possible that we do then have a consolidation period and then break higher. And if that were the case, the broader market would likely be going into a bear market. But statistically, and we'll look back here historically just to kind of make my point, it's not common at all. So with that said, if this is to roll, it would be very positive for the bulls and would further build to a potential bull case for the markets. Obviously, through all of the pessimism, all the headlines, how things look technically, how things look in terms of market breadth, it's very difficult to be optimistic. However, it's little things like this that can act as little glimmers of hope. And to conclude, the 10-year yields, which put a large amount of pressure on risk assets, are currently very extended in their trend. And if they were to reverse, it would be very bullish for the broader market. If we just look back here, in a downtrend, just like in an uptrend, generally you have 3 legs down, and then you reverse. Here we have 1 leg down, 2 legs down, reverse. Here, 1 leg up, 2 legs up, reverse. 1 leg down, 2 legs down, reverse. 1 leg up, 1 leg down. This was more of like kind of choppy, but 1 leg up, 1 leg down, 1 leg up, 1 leg down, 1 leg down, 2 legs down, 1 leg up, 2 legs up, 3 legs down. So you can see up to 2000, the last 23 years, we've not had 4 legs up. We're having 4 legs up. So it's just food for thought. Really, there's no reason to do anything right now. It's also short-term extended, I believe. Let's fact check me here. No, it's not. So this could go higher, but we got to be open to all the different scenarios, possibilities. If this does start to base and then break lower, lose this 30 moving average, it would alleviate pressure off of the S&P 500 QQQ. So anyways, moving on to gold. Gold had a very powerful move on the over the course of the last month. We actually broke down into a stage 4 decline, which if we take a look at the weekly here, you can see we had a basing area here. We broke down. However, the bulls very quickly stepped up. So what we had here was an undercut. So an undercut is when price breaks lower, but very quickly breaks higher, recaptures the pivot, and is now back within that basing area. So we're technically right back in this basing area. However, if we break higher, we're now have a stage 2 continuation. We're we could potentially see gold go to new all-time highs. And if that's the case, trading gold stocks can be extremely profitable because when they move, they move. We'll look at a couple in just a second. But going back to the undercut, I just want to look at it on the daily here. So it was a very sharp move down, a very sharp move back up. An undercut is only when you have those characteristics. Very quick reversal. If you see price break below like this and then kind of move sideways for a couple of weeks like this, you don't have an undercut. You likely have a price movement to the downside that's now forming a continuation pattern and a breakdown. If it comes back up after this extended period of consolidation, very suspect, and it still wouldn't be considered an undercut. The reason undercuts are so bullish, especially in later stages of a basing formation, is because it's basically showing one last effort from the opposing force. The bears were unable to, take control. The bulls asserted their dominance, and now they're going to really take grip and move higher. That's just how things work. If you look at the QQQ on the daily chart, you can see here that we had this brief basing period back in May where we broke down. The bulls very quickly stepped up, took control, and then blew higher. So we have something similar in gold. It's just something to keep our eyes on. We're now at a major resistance level, previous high where we got rejected. We're also at a 2,000 psychological level, which is always acted as resistance for gold. And now we're kind of just consolidating. If we're to break out of this consolidation, really take out this high, there's a couple stocks that I'm watching. The first one is AGI. This is the strongest gold stock in the market right now, and it's liquid for options. So it's something that I'm watching very closely. Earnings are out of the way. That's great. We're now in this little consolidation. We had a very strong move up. We're above the 200. We're above the 50 moving average, which is now rising. And we're consolidating what looks to be like some kind of bull flag. However, I don't like the wicks here, but it is what it is. That's how gold stocks generally move. So you can see we had consolidation here, consolidation here, consolidation here, and now we're at our fourth consolidation. First, second, third, fourth test of the moving average, of a resistance level or support level usually does the trick. So if we do resolve out of this consolidation area to the upside, I will be very interested in taking that long. You can see the moving averages have now caught up. We have a long-legged doji here, and then we have an inverse hammer here on above average volume. So really we want to, at the very least, clear this long-legged doji and this 1307 level before looking to go long. If very conservative, you could wait till we clear this inverse hammer, which clearly showed there was some supply in this area. If you want to make sure that we're through all of the sellers before breaking higher. But we're in a very nice base here. This is about a 4-month base, give or take. And there's a lot of market participants that got involved with there. There's going to be a very strong reaction should we break out to the upside, because there's going to be a lot of people that are short here and going to have to cover. There's going to be a lot of people like you and I that want to take those short-term trades. And there's also, this is a place where investors are going to be interested in getting involved. So there's going to be a lot of different eyes, and that could provide us with a very powerful breakout that we're going to want to watch very closely. So this will likely consolidate into the FOMC, because that's likely what's going to dictate gold's next move, because that's going to affect the dollar. It's going to affect the yields. Gold moves inverse the dollar and the yields. So with that said, want to watch the FOMC not watch it, but the reaction to the FOMC very closely, because it's going to affect a lot of different commodities and risk assets, and really how we're going to approach the markets. Here's GFI. This is another gold name that I'm watching closely. You can see that we had a very, very strong move up here. We have 1, 2, 3 gaps that are left unfilled. When a stock gaps up and leaves a gap unfilled, that's very bullish, right? Because generally stocks fill gaps. So if they don't, that's out of the norm. It's telling you that there's a lot of strength there. The bulls aren't willing to give any of it back. We then ran up into a former high volume close, and that acted as resistance, no surprise. And now we are consolidating and just found support at the rising 20 moving average. So technically speaking, The best entry in my eyes would be for us to break above the prior high, just because of how gold stocks can move. They can move funky, right? So I would like to, this looks like cup and handle, by the way. I would like to break above this high, go long over 1450, 1460. First price target being the unfilled gap over here. And then, hopefully we break through that and, ride out the remaining position. But for those curious what a high volume close is, it's when you have a very strong move to the downside on heavy volume. The high of that candlestick is going to act as a major resistance, just like a high volume open, which is a very bullish candlestick, moves higher, and the low of that candlestick generally acts as a strong support. Not the case in this instance. However, it is something to add to your tool set. If you look back and back test it, you'll see it for yourself. It's very helpful. Take note right here. So that's what the two main gold stocks I'm looking at right now. Quick look at Bitcoin. Don't want to take up too much of your time here. You could see that we had a huge breakout to the upside, and now we're consolidating sideways, which is great. Very extended here. We're likely going to need to see some sort of extended consolidation like this or like this before having another leg up. It's just not a place to really go long right now. And quite frankly, there's no crypto names that look appetizing at all. They really look like crap. They're all below their 200 moving average. The 50 moving average is declining, so it's not likely that these see any kind of move to the upside, these indexes, until this starts to flatten and roll to the upside, or ascend to the upside. Same thing for Riot, except it looks even worse. Mara looks bad. Coin is the worst of them all, where it gave up all of the gains despite Bitcoin roaring to the upside. But that could change with earnings, right? So we have earnings right around the corner for the crypto names. Until then, I don't think there's going to be a whole lot to do there. I hope that by the time earnings roll around, Bitcoin will have consolidated for a period of time, and they'll have strong reports, and Bitcoin will break out, and then there's tradable, right? But we'll have to see. They're also going to need the broader market to participate as well. And until they do that, until there's some kind of bullish movement in the QQQ or S&P 500, all stocks are going to struggle. So right now, Bitcoin, we're just letting it consolidate and then hopefully breaks out of that bull flag. Let's take a look at the Great 8, right? The most liquid names. How have they done so far in terms of earnings? Not so hot. Google, gap down unfilled, gap down unfilled. Now it's short-term extended from the moving averages. The bear case here would be that it consolidates for 3 to 5 days and then breaks lower, and then you could use that 200-day moving average as your price target. However, if you were looking for the upside, we're looking to see the same kind of price action unfold here as we are with the indexes, where these rolling averages, kind of catch up, and then we're looking for the first test, a pullback, and a break higher. Simple as that. Right now, Google, not a whole lot to do here. It's a very damaged chart. Need to give it some time. Apple reports next week. Not a whole lot of weight on this 200-day moving average, although I would wish it never would have occurred, that it lost the 200-day moving average. Earnings could cause it to gap right back up above it. Mind you, it's also rising, so there's more favor that it does break back above it. We'll have to see. There is an impending death cross that could occur within the next 3 to 4 weeks, which would be very bad for the broader market if we did get that and Apple continued to roll lower, simply because of the weight of Apple and Microsoft. Microsoft did gap up, and it is holding a key moving average, the 50 moving average. However, it did fill the entire gap, which was not really what you'd like to see. However, we are in a nice base here. So if Microsoft were to kind of figure it out, move sideways, and then break higher, that would really help the broader market. We're going to have to see, how things unfold, but it's nice to see that it's still well above this very steeply rising 200 moving average and holding all 4 moving averages as of right now. If the market does reverse, we could see Microsoft, it could take enough pressure off of Microsoft, and it could carry the market up higher. We'll have to see. Amazon was nice to see that we filled this gap. Obviously, there's a lot of wick here. Really no surprise when you see the rest of the market getting taking as much pressure as it did. I would have liked to see it held a nice bullish candlestick but it didn't. It's fine. Maybe it comes down, it fills this gap, and then moves higher. We'll have to see. The 50 and 200-day moving average are converging now. Potential death cross by late November if the trajectories remain constant. So as you can see, a lot of the most heavily weighted tech names are setting up for death crosses, which is not what we want to see. Meta, although it did have a poor reaction to earnings, it's still in this base. So until you lose this base area, there's not too much concern in my opinion. I would prefer it be above the 50. However, it's moving side. Look at the Meta's chart. You see how it's just very sideways consolidation. It's very tight. Now I look at the QQQ, which is downtrending. So Meta is showing a lot of strength. I mean, it's not too much of a concern as of right now where it stands unless it loses this low, and it loses the low on a very strong volume. Let's look at Amazon. I know we just looked at it, but you could see also, if you compare this to the QQQ, QQQ is in a pretty firm downtrend as of right now. Amazon, it just lost this sideways consolidation. So, and it just reclaimed a major level too. So the great eights, Microsoft moving sideways, Apple not kind of moving with QQQ, Google was moving sideways, just lost the key level. Most of the great eight are kind of moving sideways, although there's a couple outliers. So although things don't look too hot as of right now, they're all doing what we would expect them to do if they were to continue to move higher, right? So Nvidia here, it's moving sideways. We do have a ton of distribution in here. We also have a head and shoulders pattern, which is not what you want to see at all. Earnings are in about 3 weeks. If we were to break down from this major pattern, I would expect that it would need a major catalyst like earnings. However, it could very easily break down, and then it could roll and then recapture this level in the coming weeks. It could just roll all the way down the 200 moving average, but not a pattern you want to see develop. You accompany that with the volume profile, which is on the basically, there's a lot of heavy volume selling candlesticks within this base, which is a sign of institutional distribution. Here on the right hand side, the right shoulder, a lot of heavy selling distribution. It doesn't look good. It looks favorable for more downside. So we'll have to watch this one closely. Tesla also very weak, much like Apple, has that huge gap down. It's consolidating at the rising 200-day moving average. It's extended from the short-term moving averages. So what we're really waiting to see here is it going to kind of just consolidate in some bear flag and give us a potential short opportunity? That's what I'm looking for in the coming weeks. I would love to potentially play continuation to the downside, but it's going to take some time. If it maybe moves sideways until Wednesday, the FOMC meeting, and then breaks down on the FOMC, I'll look to short it there. But this is probably the one that looks most prime for any kind of actionable trade in the upcoming week. Microsoft is just kind of not much to do there. Apple's extended. Google extended. Amazon just kind of in chop right now. Nvidia, I don't know. I don't like how their earnings is right around the corner. I guess it is actionable. But for me, Tesla is the best setup in terms of the liquid tech leaders, and I would look to short it if we had a strong breakdown on a catalyst such as the FOMC. If you look also at other automobile names like Ford, it had a huge move to the downside off of earnings on Friday, 12% move, which is nuts. And we let's take a look at it in terms of stage analysis. It's moving into a stage 4 breakdown. So now a prime short candidate. It's also doing so on heavy volume. So what we're looking for in the case of Ford is just for it to essentially let these short-term moving averages catch up. And by the time it does that, it will have already consolidated some sort of bear flag, and then you look to play the continuation breakdown. I wouldn't be surprised if it continues to the downside on Monday and then maybe starts to do its consolidation, but we'll have to see. If we do add the 50 moving average and the 200 back, before I remove these short-term moving averages, take note of how extended price is from the 10 moving averages. So very risky to short here. In fact, the risk reward is very unfavorable. But we also can take into account whether or not it is intermediate term extended. So is it extended from the 50 moving average? So what we're going to do is just from the 50 moving average to price, we're going to see it's currently at 18% of an extension. It's 18% below the 50 moving average. And just go back and see how extended does it normally get before you see some sort of meaningful reversal or consolidation. Well, here it was about 16.5%. Here it was about 23%. And here in the middle of the bear market, it was about 19-20%. So you could say that around 19-ish, 20ish percent, you would consider it intermediate term overextended to whichever direction, here in this case to the downside, which means that we're going to expect to see some sort of meaningful consolidation in the next week or two before we see any kind of move with momentum develop again. So until then, don't short, or at least I wouldn't short, because you're overextended and the likelihood that you see any kind of significant move from here to the downside is very low. So your risk reward unfavorable. Wait for the consolidation and look to play a breakdown of that consolidation. Here's a name I'm watching for a potential short, AA, Alcoa Corporation. You can see we had this strong move down, heavy volume, and now we have a very nice controlled sideways consolidation, bear flag forming here as it lets price or the moving averages catch up. So if we break down below the previous low, look to go for a short there. So that's kind of what I'm looking at right now. So real quick, let's look at the McLean oscillator, which kind of measures short-term overbought, oversold conditions. Really, it's market breadth. So the amount of stocks that are oversold versus those that are overbought. And then here we have the McLean summation index, which does the same thing. However, it's on a much larger scale. We're looking at more intermediate long-term trend. And then we have the fear greed index. Why I'm looking at this is because markets find their bottoms at extremes, whether it be extremes to the upside or whether it be extremes to the downside. That's where you're going to generally see topping or bottoming patterns start to form in terms of the technicals. So if we just look at the summation index right here, which I think is at a very interesting spot right now. It is currently at the last time the market has been as oversold as it is cumulatively. So just the overall market, all the sectors, you could see that that was back in October, which was where we bottomed in the previous bear market. If we were to go back further, we could see that the next most recent time we were this low was back at the COVID lows. Now, do note that where we're at right now, during COVID, saw us go lower. So it doesn't mean that we're at a bottom. It just means that we're currently at the extremes. My point here is that you can see we're at extremes, and generally you see bottoms form at the extremes. Here, this is back in 2018, which it was an interesting time because the circumstances are fairly similar to where we are right now. The market did not like the Fed's policy. They were not confident in it, and they were letting him know. So the market ended up bottoming here off of some sort of pivot, right? So I wouldn't be surprised. This is why I'm kind of optimistic that, Powell's trying to work with us a little here. We'll have to see. We were oversold also earlier that month, or about 2 months prior, which did turn into some sort of move to the upside, which was about 9%. So even if it's not a major bottom, even if it's just the start of a secondary trend, a counter trend, it is generally pretty significant of a move. Here was 9%. If we go back here to the previous bear market, here when we would get these levels of oversold, the counter trend moves were quite significant. 9%, again, 11%, and then of course, moves like this, 20%. So my point here is it doesn't mean we go right back into a monster move to the upside. It just means that we're likely to get some sort of significant move in the near term. Doesn't mean we don't see more downside first, but do be prepared to play that long side. Even if it's some sort of short squeeze, there will be long opportunities in the near term, and we want to be aware of that. The McLean oscillator is also in the extremes. And then the fear greed, which is measuring the overall optimism or pessimism of the market, is also deeply oversold. So we're in the extremes. Also, if we take a look at the amount of stocks above or below their 50-day moving averages, let's go over here. You can see that we're also, if I just zoom out, at the extremes. So market bottoms are formed, major turning points are formed at market extremes. We are in the extremes not only in terms of overbought, oversold from the technical standpoint, but also all the market internals are showing the same thing. So it wouldn't take a whole lot to catch people off guard and cause some sort of squeeze to the upside. So we just want to be aware of that. That's all. That's where we stand right now with regards to the technicals. The market internals. Very oversold. Market breadth looks horrible. Need that to improve, obviously. However, at the market extremes, we can expect at least some sort of bounce to the upside. So with that, taking an account of, be careful shorting while in such extreme conditions. If you're going to do so, no problem. Just have a very tight leash on that. Also, the technicals are showing that we're extended to the downside as well. At the very least, we want to see some sort of consolidation in the indexes in the next couple of weeks before another meaningful move to the downside, unless we of course have some sort of crash, which you can never take out of the equation. However, they're very rare. Okay, if it does happen, you'll see a lot of volume come in, and that volume will justify going short despite the overextended market conditions we're currently standing right now. That's where I stand right now with the market as a whole. I hope you guys enjoyed, and as always, feel free to ask any questions you may have in the comments section below.